Your money, your business. This is Financial Poise Radio, the spoken word sister of FinancialPoise.com.
Hello, everyone, and welcome to Financial Poise Radio. I am Christopher Cahill. In a few minutes, we'll be speaking with Jason Stevens of Sprott Global, not for the first time because he's an interesting fellow. Stevens will be teaching us about real asset companies as an asset class. Real asset companies. Well, the term doesn't define itself. What is meant by real asset companies? We'll find out, but naturally I thought, is this like Real Housewives of Beverly Hills or Real Housewives of New Jersey? Well, I'd rather it weren't. And as I say, that the meaning of that term will be explored by Mr. Stevens later in the program. But first, a few reflections on recent journalism having to do with things our audience is interested in. Ken Sweet of the Associated Press published an article about payday lending. The article is dated July 6, 2016 on the Associated Press. Titled, If Payday Loans Go Away, What Replaces Them? An excellent question. You see, the Consumer Financial Protection Bureau has issued regulations. They don't have the force of law yet, but undoubtedly they will in some form or another after the regulatory process runs its course. Well, wait a minute. What are payday loans? If you don't know, I suggest you walk into a payday loan office and find out what they are, and get a feel for what these places are like. You see, the tall and the small need liquidity. The tall can go to banks. The tall can go to credit unions. The tall can go to fintech, which we've spoken of many times on this program. But where do the small go when you have no money and all you have is a paycheck coming in a week or two, but your car is broken, and a broken car requires at least $600 to fix? If you've had one break on you lately, you know that, and could be substantially more. And if you don't have the car working, you can't get to work, you're in a pickle. You need liquidity, and you need it now. Well, payday loan outfits can help bridge that gap. It's as simple as agreeing to give the lender access to your checking account as of a future date, and the lender can go there and take out the money it gives you today. Or you might give the lender a post-dated check, which amounts to the same thing, usually 14 to 30 days out. All right, so what's so bad about that? Well, I think many of us know what's so bad about that, or what really does look bad about that. Payday loans are often not paid off in 14 to 30 days because the person borrowing the money doesn't really have the money to pay it back even when his or her paycheck comes in. The CFPB has found in a 2014 study that 60% of all payday loans are renewed at least once. 22% of all payday loans are renewed at least 7 times. Repeat borrowers make up 83% of loan volume in a given year. I'm summarizing data that was presented in the article. And that's bad because the interest rates are, to an objective observer, heinous. Now, to a payday loan provider, the interest rates may be necessary to recover the inability to collect from borrowers whose checking accounts close in the interim, or for any other reasons. At any rate, payday lenders have to make money. They do. Apparently, they seem to do very well. The CFPB wants to protect the small from being gouged by payday lenders. According to Mr. Sweet, the regulations at issue would require payday lenders to determine each customer's ability to repay the loan within the time allotted, and would limit the amount of times a customer could renew the loan. Well, if you've been to a payday lender shop, which I've already encouraged you to go visit, you will find a small, not very nice waiting area, dimly lit, well, maybe not dimly lit, but not very well lit. And you will find bulletproof glass and people standing behind that bulletproof glass ready to give you some money, provided you sign the appropriate papers and promise to pay back large interest rates if you renew or are unable to fulfill the terms of the original loan. Okay, so CFPB wants to stop that. Well, what will happen to payday loan originations if the regulations are successful? They will come close to disappearing. The CFPB itself acknowledges that the volume of payday lending would decrease under the regulations. But let's say the volume does plummet, does fall to nearly nothing. What would replace payday lending? Because we have to ask that question, which Ken Sweet asks, because they need liquidity. People need money. And sometimes they need it now before they have enough money to actually do it. They need the money now, and maybe they can try to pay it back later with their earnings. Well, briefly, pawn shops are likely to benefit. This is an irony, given that under Operation Choke Point, the federal government recently targeted pawn shops, and you can read about that in the American Banker. Article by Dennis Ross dated March 4th, 2015. Don't buy the spin. Operation Choke Point targets legal businesses. All right, so pawn shops might benefit. The CFPB has suggested that banks and credit unions could pick up the slack and lend to the small, served now by payday lenders and pawn shops. Well, let us wonder how they could possibly think that if banks and credit unions could make money or break even on such loans, they'd already be doing it. And if they were to do it, they'd have to charge interest rates that no doubt strike us as high, even compared to credit cards. So there's one other possible actor that might be very happy with the CFPB regulations, and that's Fat Tony, or whoever fulfills the function of Fat Tony in a given neighborhood, that is organized crime. They have a great tradition of lending to the small and a great tradition of gouging the small, or worse. I hope I am wrong about all of this, and maybe you believe I am wrong. I hope you're right and I'm wrong. I guess we're going to find out once the regulatory vetting process has run its course. Moving on. Financial Poise just gets better and better. I've noted over my years of association with Financial Poise. And there are all kinds of articles in there. There are some that are light, some that are heavy. I'm going to talk about two of the geekier articles because I really like them. I guess that makes me a geek. Adam Hirsch has a regular column called Alleged Frauds, Fakes, and Ponzi's. That's the name of the column. Who wouldn't want to read that? Mr. Hirsch, by the way, will be a guest on this program in a few weeks. Well, he just published on July 5th an article on Financial Poise entitled Massive Failure Equals Massive Litigation? ? Maybe, maybe not. And he contrasts Volkswagen with a company called Theranos. Volkswagen did something bad, allegedly cheated emission standards. Theranos did a whole bunch of things that were questionable. And the Justice Department and Securities and Exchange Commission have active investigations. Okay, why was Volkswagen sued 350 plus times and had to pay a large amount of money for a consolidated settlement? And why has Theranos not been sued at all? Interesting question. To those of us, either those of us who think businesses are sued too readily, especially big ones, or those of us who think big businesses are not sued often enough for taking advantage of people, for lying, for engaging in various kinds of chicanery or worse. I urge you to read Adam Hirsch. He's an entertaining writer. Looking forward to his interview on this show. Finally, if you really want to get geeky, but it's not so geeky, I say, after all, accredited investor markets have been a fundamental part of Financial Poise throughout its existence, and that part of the company has always served accredited investors, people of means who buy shares in private companies. Why would you do that? Buy a share in a private company? Well, because you expect to make money from the investment when you sell the share someday. Sell the share to whom? No, seriously, to whom? Well, private companies can become public companies through something called an IPO, an initial public offering. Sometimes that's where you cash out these private shares. However, it is theoretically possible and even practically possible to sell them pre-IPO, sell them as pre-IPO shares. Well, with the explosion of private companies as opposed to public companies, with the greater amount of capital going into private companies in recent years, there's been great interest in facilitating sales of pre-IPO shares from owner to buyer through marketplaces that have been created online and also through platforms online which facilitate buyer and seller interchange, which broker relationships between buyers and sellers of pre-IPO shares. Well, it's an interesting world, and Mr. Robert Rapp of Calfee, Halter, and Griswold published a lengthy article on accredited investor markets called Fundamentals of Pre-IPO Shares, Revisiting Private Trading Platforms for Restricted Securities and Paths to Liquidity. Now, the key to all that isn't the length of the article. It's long because it's good and because the topic requires that amount of length. It's an unusually long article for accredited investor markets. The key lies in the last words of the title, Paths to Liquidity. If you're investing in private companies, you need to understand paths to liquidity. And this article does a fantastic job of doing that. So I urge you to look at Mr. Rapp's article. Now, we move on to real asset companies. Jason Stevens is a natural resource specialist and investment executive for Sprott Global Resource Investments, a boutique investment firm specializing in natural resource investments, including precious metals, base metals, oil and gas, agriculture, water, and alternative energy. Jason has spent the last 12 years working with mining and petroleum engineers, industry executives, economic geologists, and more recently, farmland specialists. Jason has been a featured contributor to industry sites such as Resource Investing News, Financial Survival Network, and the Contrarian Investor Podcast. I kind of wish that was the name of this podcast. It's a good name for a podcast. And this is Jason's second appearance on Financial Poise Radio. It's good to have you back on the show, Jason.
Thank you, Chris. Glad to be back.
All right. Well, we've decided that we are here to discuss a particular type of asset in which one might invest. What that asset is, what advantages there are to investing in it, and how to distinguish good assets from bad assets within that asset class. So, Jason, what are, quote, real asset, end quote, companies? And what is it we are speaking of investors getting and holding?
Well, in my terminology, real asset investing really revolves around the idea of holding or investing in companies that produce kind of the base of society's needs, whether it be food, energy, or things that we use like raw materials to manufacture our shelter, or anything else that produces electricity, utilities, those sorts of things. So one of these things, it even revolves around stuff like gold, which has historically been used as a monetary metal and also a financial asset outside of traditional currencies, and something that you can actually save in terms of.
Oh. Well, okay, so what we're talking about is not buying gold, but rather buying an equity stake in a kind of company, right?
Correct. So those industries are always industries that are going to be around, and these are the companies in which produce them, have some sort of relativity, provide financing to, but they are providing services in the industries revolving around real assets. And really that's mining, energy, and agriculture.
So we're not talking about commodities futures, or even bonds, or investing in the debt that is borrowed by these companies, but rather owning them.
Correct. What we're really talking about is owning equity stakes in these businesses and deciphering the quality companies from the rest of the pack. And we all know that these are some of the most cyclical industries out there, simply for the capital intensity of these types of businesses. So we're looking at equity stakes because obviously with the hedges to inflation or inflationary pressures, really what you want is you want to make sure that your company or your equity stake keeps up with those inflationary pressures.
But wouldn't, to stick with the gold example, wouldn't buying gold itself help you keep up with inflationary pressures? Why then, if that is the case, and you can tell me it is not, but if that is the case, then why not just do that instead of investing in a good quality real asset company that mines gold or does something else in connection with the production of gold?
Well, so that is what I'm talking about, is kind of investing in those sorts of mining companies. And that is one, obviously I always tell people, if you want exposure to gold, you first have to have an asset class. You might first want a position in physical gold. But if we're talking about really getting exposure to alternative assets and the upside to them, companies that have production usually give you leverage, not financial leverage, but more operational leverage towards the prices of those commodities. And it's specific business models and businesses within those industries that asymmetrically outperform those metals on a consistent basis. So they actually outperform the gold-related indices, even though what they're doing is either mining themselves, investing in other miners, they have royalties on mining projects, those sorts of things. That's where we continue to see opportunity because of the business model and the cash that those business models generate.
Okay, so you could invest in corn, the commodity, on the theory that we'll always need it. And especially in periods of high inflation, it might be a good thing to own contra inflationary pressures. But I think your argument is that if you invest in ownership of specific companies, not all companies, but specific companies that are involved in the growing and distribution of corn or some other agricultural commodity, you're going to draw some upside. It's not just going to be an insurance policy, but rather some kind of investment positive compared to owning the underlying physical asset.
That's right, and it's very important to decipher, if we're talking about farmland and agricultural type investments, the selection of management and people involved becomes very, very important. There was an article, several articles within the last 2 months telling us how the broad real estate indices in farmland this is the lowest we've seen them come off, or the most that we've seen them sell off since the 80s. And it's very important to understand that there's not one farmland market in the U.S. There is hundreds, if not thousands, of different jurisdictions which have exposure to different types of crops, have access to land that have different types of issues, including soil and irrigation issues. So it's not really, I like to tell my clients and other investors that it's not a stock market, it's a market of stocks. It's the same thing with land. So you really have to be very specific to the manager and that he knows the localized markets of the farmland that they're either farming or they're hiring farmers to farm for them, because every area specifically has different issues.
So it would be fair to say that, especially when it comes to something like farmland, which has seen better days and not that long ago, you should resist the impulse to buy when others are buying because others are buying, or sell because others are selling, but rather familiarize yourself with certain particulars that pertain to that particular property, but rather agricultural company or farmland using company that you might wish to buy.
Right. Every investment in farmland is, like I said, every piece of farmland, every crop, every property that produces a specific crop has different options and has different challenges. And you may see one piece of property that you can add, let's say, a grain silo, and it will increase your revenue by, let's say, 25%, or your ability to store the content for higher times in the commodity market, so you can sell that grain at a higher price and increase your returns irrigation is always an issue in certain parts of the Corn Belt and not in others. So it pays to know your market, and it pays to know the land that you're working. So yes, there's the cap rates or the capitalization rates which many real estate investors use in order to value any sort of real estate has been pushed down because farmland has become a interesting investment to a lot of the pension funds and institutional investors. Well, that's an opportunity for the smaller investor in the farmland areas, because there are always still going to be those pockets where there are less sophisticated investors, or, quite frankly, you could be a seller to those institutional investors. So there's certainly opportunities within farmland still, both to sell assets that may be overpriced to an unknowing buyer, or I don't want to say unknowing, but maybe a buyer that is the hot money, which needs a lot of land and is willing to push down those return rates on specific land just because they need so much acreage. And then there's other opportunities where adding economies of scale onto an existing farmland position may actually make a lot of sense for some investments.
It sounds like to do this the right way, by your lights, you have to, or your advisor has to, get out of the office, get in there and look at the farmland. Or maybe if we could shift to mining, what sorts of factors that don't immediately come to mind would account for why one mining company is a better bet than another?
Well, at Sprott, we have a term, or basically a phrase, meaning grade equals profitability or cash flow. And when we're talking about mining, that could be a gold grade. So what that refers to is when you're looking at mining ground, for every, in terms of gold, a high grade gold deposit may have more than 5 grams of gold per ton of dirt moved. So for every ton of dirt you move, you want to find 5 grams, and that's a very high grade. But that grade is very important because obviously the more grade you have, the less rock you have to move, the less labor intensity you have in that project. So that's a very important metric that we use. Now, grade doesn't always minimize cost, but sometimes what you'll get in the best projects is that you get high grade, which leads to a lower cost project in terms of where the grade is, where it's concentrated. So that is one of the most important things when we look at a project, especially in areas that may have higher geopolitical risk. They're much more in favor of looking at gold projects at surface rather than going underground, and also looking for that higher grade gold deposit, which means it gets developed easier, faster, permitting is easier, and you get through that process much quicker.
And I know we're leaving out a lot of important factors in the case of agriculture a minute ago and mining at this moment, and we'll get to some of the more businessy financial factors in a moment, but we're acknowledging that at this point. But just sticking with what you were talking about, just the factor of grade in a mining project. We're buying equities in real asset companies. Are we buying public equities or private equities? Does it matter? Can you get the kind of information you need from a private company, or what are your thoughts on that?
Well, so certainly if you are in the business of financing these companies from a private stage, you can get the information if you're dealing with a more institutional type investor that you're investing alongside, kind of like Sprott. But if you can't get all that information because it's not a public company, there are public company requirements by the exchanges and the SEC, most notably documents 43-101, which kind of give you the resource, basically measured and indicated resource ounces and reserve ounces. So that is important. Obviously, that doesn't necessarily tell you the quality of the ounces. So quality meaning, is the metal recoverable? Is that metal, what grade is that metal? What's the profitability of that metal? it'll give you the broader scope of how they categorize reserve ounces measured and indicated, and then inferred resources. So potentially all that is the confidence of the exchange based on how many exploration holes that have been drilled into that project. So that's kind of how you will take public documents and read into what potentially is the in situ metal value and what is exploration potential.
Okay, let's get out of the field and get back to our portfolios and our basements, or whatever it is the location is from which one makes one's fundamental personal investment decisions. So would you comment then on how, I mean, we're re-asking a question from earlier, I realize, but within the portfolio context explicitly, how investment in a high quality real asset company operates in a portfolio differently than investment in, say, a commodity or a metal, which is a type of commodity.
Right. And so when we're looking at some of these companies, it's very important because they are every commodity related business, whether it be mining, for the most part, agribusiness across the scale, or energy companies, both or all three, downstream, midstream, and upstream, they're going to be relatively or absolutely price takers. So that is what creates the problems that we're currently seeing in the oil fields. And in terms of the metrics, you have to realize that these are very capital-intensive businesses, which require thousands of people in terms of a mine, thousands of people in some cases to run farms or to produce certain types of, whether it be the contents of fertilizer for the agribusinesses, oil and gas consultants, and all the other people and equipment. All of them are very capital-intensive. So what I always look at is kind of the opportunity to reinvest capital at high rates of return. So their opportunity is, one, does the management have a track record of making those high return investments over time and the opportunity to make those investments? So a couple metrics that we use specifically for resource investments, not necessarily wide scale looking at other sorts of investments, is return on invested capital. So return on equity and return on assets are good measures but can be manipulated. So really we look at a return on invested capital. So money that is not being used for any other purpose except for investing in their core business and the return on that. And that needs to be higher than their weighted average cost of capital.
Well, let's explore that in a moment. But would it be fair to say that real asset equities do not correlate really with the S&P 500? And would it also be fair to say that they're less volatile than the underlying commodities, if that's what's underlying?
That's an interesting take on things because really they have lower betas or correlations to the broader equity markets. That doesn't mean they're less volatile, it just means there's low correlation between these sorts of equities, these sorts of investments, and the broader markets. Farmland specifically has very low correlation to equity drawdowns. So 2008 and then periods within the 80s and 90s, we saw positive returns. At the same time, we saw large drawdowns in the equity markets. So that is one reason. In fact, we did a study here at Sprott between 1985 and 2005 by replacing 20% of a traditional 60-40 investment portfolio with real assets, and again, that's diversified between mining, energy, and agriculture, that you actually increased your expected return and decreased your total risk. So at the same time, you're adding one other non-correlated asset class.
But you're doing that indirectly though, right? I mean, it's not like you're investing in gold, farmland, and oil. You're investing in companies that do these things.
Right.
so that you should be less volatile than investing in those underlying commodities, but smoother too. I mean, you don't end up being as volatile as all that while you're earning some return that doesn't exactly correlate with the market.
That's exactly right. And that's so I would stress that not every equity investment in a mining company or every investment in energy company, as we're finding out now, is less volatile than the actual underlying commodity.
Mm.
But what you need to be very focused on is the balance sheet and the profitability at very, very conservative commodity prices. So there has to be a business plan and a business model in place that can take advantage of both low and high commodity prices.
That is such a powerful point. The absence of that is illustrated by the Wall Street Journal of yesterday in the business and tech section. Top article, Energy Bankruptcies Accelerate. This is a familiar story to me. I'm a commercial bankruptcy lawyer when I'm not doing this program. And it tells the story of Sandridge Energy going bust, that being the fifth energy company to file for bankruptcy in the last 5 days. 77 North American energy companies have now declared bankruptcy since the start of 2015, and there's other gaudy numbers throughout the article. And then there's a paragraph, which I shared with you before the program, that I'd like to read. And this is about a tendency among some companies not to be prepared for those times when the underlying commodity becomes worth less than it is at the time they're investing all the money. Most of the companies, the article says, facing financial duress are small and mid-sized U.S. shale producers and the service companies that help them drill. And then the sentence I love, fueled by cheap debt from Wall Street, these companies rapidly expanded over the last decade as the U.S. unlocked vast new oil and gas reserves with advanced technologies like hydraulic fracturing. End of quotation, although we might also add that oil prices were hitting some pretty gaudy highs a year and a half ago.
That's absolutely the case. These business structures where, as I mentioned before, the businesses are essentially price takers, and then what you have is you have a banking system and a financial system that knows too little to not provide capital at the wrong times. So as
wait. A banking system that knows too little not to provide capital at the wrong times. That is worth quoting, my good man. I hope I remember that. But please go on.
Okay, good. Feel free to use it as a headline.
Yeah, I will.
Really, what I'm saying is that you have bankers that are used to different types of businesses, and what happens is we were talking about those SEC documents which talk about reserves and dollar value of assets. As things increase, like dollar value of oil, those reserves in the ground and the current cash flow gets overinflated. And at the top, because prices and returns look so good on the current barrels that are being produced, these bankers are more comfortable with providing large amounts of debt. So you're actually getting a double bump on the way up because you're leveraging your balance sheet more and you're getting a higher dollar amount for your oil. So at the top you have companies that have debt to cash flow of something like anywhere from 4 to 6, 7 times. Well, what happens when oil prices go from $120 a barrel to $40 a barrel in that same context with the same amount of debt is that 7 times becomes, 5 times 7 times. So we're getting to the point where distressed selling, distressed debt all becomes an issue to move backwards in terms of the high quality or the high cost producers. Like the article was saying, the shale oil producers, which is kind of the oil sands of the U.S.
So yes, don't buy them when they're up in teens and 20s and 30s. Let's talk about price to earnings ratio. The reason I'm particularly interested in that is that when you talk about high quality real asset equities, you're starting to sound to me like a kind of Warren Buffett type approach to investing in general. And we've had a votary of Warren Buffett's approach on this program twice. His name is Vitaly Katzenelson of the Investment Management Association and the Contrarian Edge blog. Very interesting fellow and very worthwhile to listen to, I must say. Well, he did not fixate on the price to earnings ratio, but he talked about it a good deal. There are other factors, he would say. But if you can buy something with a low price to earnings ratio, you're probably buying an undervalued asset. And that's something to look for, among other things. Now, what are some problems with price to earnings ratio as a measurement device when you're trying to do high quality real asset investing?
Being a Graham and Dodd type investor, fundamental value investor, you do understand that in most businesses, price to earnings means a lot more than it does in kind of the real asset or the natural resource companies, simply for the fact that there is so much depreciation in these sorts of projects, which basically take down the E portion, but can still generate the P. So some of the metrics like return on invested capital kind of show what the return, the free cash flow returns are better than the price to earnings ratio are. If you look at probably one of the best performing mining or precious metal related stocks, Franco-Nevada, I had a client ask me, and actually several institutional investors ask me, how can I invest in this? This is a company that trades at this time when gold was almost at its recent low. It was trading at 55 to 60 times earnings. And they were saying, how can we buy this if you're saying this is a great value? Well, even though they have margins, profit margins, anywhere from 50 to 90% on their royalty contracts coming out of these mines, they depreciate a lot of the investment value. So they still have cash flow and a lot of free cash flow to reinvest, but the earnings look poor simply because they're depreciating the initial investment. However, these royalties, they don't have an end date. They're perpetual, but the mine life, which they're depreciating to, is finite. And that is all coming out of those SEC documents that show the resource only goes for so long. But inevitably, as you do mining, you actually find more ounces, or they end up being able to recover more ounces. So those earnings are not as important. Same thing with oil and gas. Earnings mean very little when we're talking about very quickly depreciating assets.
Okay, so among the things we've identified, at least in the mining context, grade, for example, but in both mining and energy, there's a depreciation of the assets. Its impact on the earnings measure and the duration of the mine or the well involved can also bear upon the meaningfulness of price to earnings. Well, okay, looking at the oil companies again, I'm staring at the Wall Street Journal page I was just quoting from. There are predictions in there that still more companies will go under, we've already gotten more bankruptcies in this sector at this point of the 2016 than we had all last year. And it's only going to get worse. But there will be some oil companies left. And I guess you could say the real asset oil companies will be those who survive. But is there a way, can you give us any kind of factors that will help you predict whether one company survives rather than another, and is therefore a good bet for when things swing up again?
Well, I guess in my opinion, the exploration production companies need to have, because of the volatility of the underlying commodity, they have to take a more conservative approach, and they need to. The tough part about this industry is that you're getting production quickly after drilling a well, but you have to replace and create what's called sustaining capital expenditures in order to continue that production. So one of the issues that they're having in the shale oil fields and unconventional fields today is the fact that drawdown, so meaning when you start producing on a well, in certain areas there's a fast drawdown. In some cases, in year one, you have a full amount of production, let's say 1,000 barrels a day from production. In year 2, because of their inability to keep production at the same level, you may have only 200 barrels a day from that same well. So that drawdown means that you have to replace 800 barrels or 80% of that well with new wells to keep production stable. That is where we're running into the issue with, does it make sense for the industry to continue to drill those wells? What we're learning is that we had so much of a well inventory at the time that the prices collapsed that production actually increased even though the price collapsed. And what happens is that these companies wanted, because they had so much debt service, had to go after this production out of these well inventories to pay down their debt service. So now we're stuck in a position where these guys can't borrow, they can't produce enough for their debt service, and there's low economics. So it's not about breaking even anymore. It's not even about debt service because they can't meet that. Now it's about selling distressed assets to somebody that's a healthy E&P or integrated oil company. That integrated oil company has the ability to, I don't even want to say take on leverage. I think for the most part, the oil business is so volatile that debt has to stay near zero, and you may even want net equity in the company to operate on a sustainable basis for long periods of time.
I was about to ask you about that because it sounded like debt is the devil, where of course credit is necessary in most commercial endeavor and obviously necessary to some degree, but you are kind of saying debt is the devil when it comes to an industry like this.
Absolutely. And I put it to this way to a lot of the investors that I talk to on a regular basis. How much debt would you have on your own personal balance sheet in your own life if your income could go from $100,000 a year to $20,000 a year within 12 months? I don't think you would have that much. You certainly wouldn't have $400,000 worth of debt.
Oh, now you're talking about the typical grad student.
Yeah, unfortunately.
Yeah.
With oil and gas companies, they have less flexibility too, so on that debt service.
Well, Jason Stevens of Sprott Global, thank you for coming on this program and vindicating quality as well as knowledge of specific industries over abstract speculation.
Well, thank you. I'm always glad to be here.
Okay, that was Jason Stevens of Sprott Global Resource Investments on our show for the second time. You've been listening to Financial Poise Radio. I am Christopher Cahill, the host of Financial Poise Radio. Financial Poise Radio is produced by Stephanie Strait. Thank you all for listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.financialpoise.com. Each week, Financial Poise Radio brings you news and education about finance, investing, business, and law. To see a short written summary of this episode, go to www.financialpoise.com. Financial Poise Radio is a production of Financial Poise Radio Productions, LLC.